All right, everyone. Welcome back to Money Show's Virtual Expo. We are pleased to welcome Jerry Robinson. He is the founder of followthemoney.com. He's an economist, veteran trend trader, best-selling author, and trading coach. Mr. Robinson's trading specialties includes 3 times ETFs, DITM call options, and growth stocks. He is a best-selling author of Bankruptcy of Our Nation. Jerry, such a pleasure to have you here today. It's all yours.
Oh, great to be here. I sure do appreciate the opportunity. I love presenting for the Money Show audience, and I want to welcome everybody today. It's my honor and pleasure to be here. As we had stated at the outset, we're going to be talking about 10 top rules for trading success. And along the way, if you have any questions, feel free to type those in. We're happy to address them as we go through today's presentation. So as we state, top 10 rules for trading success. As I was introduced, I have been a trader now for many years. It's hard to believe. I began trading in 1996. I traded my first stock in 1996, and it's been, gosh, I guess 25 years now. I traded my first option in 2002, bought my first cryptocurrency back in around about a decade ago. And I tell you what, I've made all the mistakes that I could possibly make that you could probably make as well. I've learned so much over the years, and I've made my own rules that I use whenever I trade. And that's what these are. I'm going to be presenting you with not just some general rules that I think might be good for you. These are things that actually I use in my own trading, and I hope they're helpful for you. You certainly don't have to adopt all of my rules to be a good trader, but you may glean some information here, and hopefully you can learn from some of the mistakes that I've made by heeding these rules. So let's move right in. And I want to remind you at the very outset that you're trading and investing at your own risk as always. I am not an investment advisor. I'm an individual investor and trader just like you. All of the information today is presented for your educational and informational purposes only. You should always consult a trusted financial advisor before you make any financial decisions, including trading. So let's talk about rule number 1 today as we go through the 10 rules for trading success. And that is to know current market conditions before trading. So before placing a trade, the first question that I ask is, what direction is the current market trend? Why? Well, because historical data has shown that 3 out of 4 stocks tend to follow the overall trend of the market. So we have a never-ending stream of financial news, and it means little to me personally unless I've seen a chart of the market's major index. So before I place a trade in the U.S. stock market, you want to know the current state of the S&P 500 index. I examine the S&P index chart in all relevant time frames to fully understand the state of the broader market. Now, many of history's top traders understood the importance of waiting for a general market uptrend to begin before they began pyramiding their capital into the day's leading stocks. So when market signals a new uptrend, I begin buying or adding positions in leading stocks within the leading industry groups within the leading sectors. And when the S&P enters a new major downtrend, then I begin lightening up my exposure by locking in gains and raising my stop losses. So if your goal is to earn money in the markets, don't fight the general market trend. Instead, let the trend be your friend. Know what the current market conditions are before trading, and you will certainly improve your overall trading success. And to that end, I want to let you know that we actually offer a free tool that will help you in this on our website at followthemoney.com/market-tracker. And we've been doing this since 2007. It's a free tool that lets you know what the current position and long-term trend are on the S&P 500. This system actually helped us get out of the market in 2008, just before the market came to a crashing halt. And the same thing as well back in 2020 when we had that big sell-off. This system identifies those trends early. So it's a free service that you can find on our website, absolutely free. And I encourage you to take advantage of it. Okay, let's move on to rule number 2. That is plan your trade and trade your plan. So most traders fail because they don't have a trading plan. Because they don't have a trading plan, they're usually held hostage by their emotions. And these emotions inevitably lead to losses in the market. So you may be surprised to learn that most traders do not have a plan or a strategy. I learned that the hard way, my own way, because I didn't have a plan either when I first got started. And as I've been coaching students over the years in the topic of trading and even investing, that's the one recurring theme that I see. Most people do not have a plan or a strategy when it comes to trading. And this is because many retail traders approach trading like a hobby. and they don't take the necessary time or invest the necessary time and energy to develop their entry and exit strategy along with a set of money management rules, such as using stop loss orders, which are extremely important. We'll talk about those in a moment. Additionally, most traders don't review their gains and losses, so they're unable to learn from their mistakes and their failures. So without a consistent trading plan that includes money management rules, most traders are usually nervous about their trades and they lack confidence, which leads them to second guess their trades. This, of course, explains why so many traders lose money in the markets. By developing a trading plan, you can control your emotions and conquer your fears in trading. So put simply, trading according to a strict trading plan prevents your emotions from keeping you out of the market when you should be in, and in the market when you should be out. Now, rule number 3 is an important rule that you may be familiar with, maybe you're not, and that is to avoid low volume stocks. Not everybody talks about this. This is something that I, again, learned the hard way. Most of these rules I'm telling you and sharing with you, I learned the hard way. I prefer to trade stocks with at least 400,000 shares in average daily volume. If the price of a stock is less than $5, however, then I usually raise my minimum volume requirement to 1 million shares. However, remember that the level of a stock's volume provides us with an instant look at the current level of interest in that particular stock. So when a stock trades on a low daily average volume, it's a sign that there's just less interest in that issue than another stock with larger amounts of volume. While it's true that stocks with low volume carry a greater potential for large moves, these moves are usually more difficult to identify in advance compared to stocks that trade on higher volume. And additionally, stocks that trade on low volume are often more difficult to sell or liquidate than their higher volume counterparts. For example, if a trader earns a nice profit on a low volume stock and then decides to sell the stock, it can take a few minutes, sometimes even hours. I had one stock that took me days to sell because it was low volume. So it all depends upon the amount of volume the stock carries. So by the time the order is actually completed, the price could be higher or lower than the trader had initially expected. So do yourself a favor and up the odds of your success by focusing your trading efforts on stocks that are more liquid with good and consistent amounts of daily volume. Let's move on to trading rule number 4 here. We're moving right along in the top 10 trading rules for success in the markets. And this rule is keep a trading journal. So over the past 20 years of my trading career, 25 years now, I've learned the absolute importance of keeping a record of my trading activity. Without a record or a journal of your previous trades, it can be very difficult to remember which strategies worked, which ones didn't. So I have a little black book that I bought. I bought it at Barnes & Noble. It's a nice black book, and it's just full of blank pieces of paper lined, and I use that, have been using that for years. And every time I place a trade, I write down several items. What stock did I buy? What was the price? What was the current volume? Why did I buy the stock? What's my stop loss? What's my initial exit strategy? All of those things. And what do I feel about the stock? That's also important. Why did I do it? What strategy was I using? All of these things are very important. All functioning systems need some type of feedback loop in order to make meaningful improvements. For example, employees at most companies must complete an annual performance review in which their boss sends them down and tells them what they've done right, what they've done wrong, what they can improve on. And your progress as a stock trader is no different. A feedback loop is crucial so that you can make adjustments and improvements. One definition of insanity is doing the same thing over and over and expecting different results each time. And if you trade securities without any feedback loop, I'd say you might be bordering on insanity, especially if you keep seeing your trading balance decrease. So your feedback loop should take the form of a trading journal in which you can record all of your trades. After each position closes, you can return to the journal entry and discover what you did right, discover what you did wrong, learn from your mistakes, lick your wounds, move on. You may be surprised at what you uncover. Let's move on to rule number 5. Rule number 5 today is always use stop loss orders. One of the most common trading catchphrases is to cut your losses short and let your winners run. Put simply, this popular phrase emphasizes the importance of not selling a stock too quickly when it's rising, as well as not holding on to a stock when its price is tanking. Ever been there? Now, this may sound obvious, but it's often much easier said than done. After all, if you're a trader, how many times have you sold a stock only to later watch it continue rising in price as you kick yourself? Or how many times have you held onto a losing stock only to watch it fall further and further in value, thinking that it has to go up, but it just doesn't. So if this describes you, you can break the frustrating vicious cycle. How? With stop loss orders. As the name suggests, a stop loss order, like a market or a limit order, is a specific order type that instructs your broker to automatically sell your stock if it falls to a price that you specify. So before I buy any stock as a trade, I first determine two very important things, actually three important things: my preferred entry price, my maximum loss threshold, and my price target, my initial price target. Once I actually place a trade to buy a stock and the trade executes, the first step I take is to immediately place a stop loss order that tells my broker to sell the stock if it falls below a certain price. You got to cut your losses and let your winners run. And cutting losses is one of the most important rules that you're going to learn as a trader. If you're a new trader, you don't learn that one the hard way. Use stop loss orders. And if you're not familiar with them, do a little research on them. Call your broker even and ask them how they work. You really want to be using that as a tool in your tool bag. It'll really save your hide when you're out there trading in the markets. Let's move on to rule number 6. Rule number 6 this is a powerful one that I've learned from many of the greatest stock traders over the last century. Studied those guys quite a bit. Guys like Gerald Loeb and Jesse Livermore, guys like Paul Tudor Jones and others. Powerful strategy here is to pyramid into your trading positions, but don't ever average down. Okay, this is a powerful trading rule that I strongly follow. One of the most important lessons that I learned early on was to never average down, but instead to average up. Now, what this means is that averaging down is an old investing idea that says that you should add more shares of a stock to your position if the stock goes below your initial purchase price, so as to improve your overall cost basis. So you buy a stock at $50, and then it immediately drops down to $48, and the average down crowd would encourage you to add more because it's on sale. Well, this is a dangerous idea and directly conflicts with the pyramiding or averaging up strategy employed by many of the greatest traders of the past century. So instead of adding more shares when a stock that I am trading goes down, I usually sell it. When I buy a stock, I'm not speculating that it's going to go down. I'm speculating that it's going to go up. And if I have a stock that I purchased and it rises above my entry price, well, then what am I going to do? I'm going to add more to that stock. So if a stock is doing what I thought it was going to do, well, I reward that position with more money. But if it goes down, you don't reward the position with more money. Now, if you're an investor, then you might be able to build a case for averaging down. And in fact, I do dollar cost averaging when it comes to my long-term investments. Well, we're not talking about investments today. We're talking about trading. So when you're trading, averaging down is a no-no. When you're investing, maybe you build a case for that, right? You dollar cost average. Sometimes you buy higher, sometimes you buy lower. That's fine. But don't fall victim to buying more shares of a losing trade. It will not only hurt your trading account, it'll set a poor psychological precedent for the future. Instead, only add more shares or average up when you're right. This type of discipline will serve to magnify your gains when you're right and limit your losses when you're wrong. And if you're like me, you'll be wrong often, and that's okay. You only have to be right 3 or 4 times out of 10 if you let your winners run and you cut your losses short. Very, very important. Let's move on to rule number 7 today as we go through the top 10 trading rules for success. And this is an interesting one. This is one I've learned over the years. And some of you may really agree with this if you traded the open before. I like to avoid opening a new position in a trade in any particular trading position in the first 30 minutes of the trading day. Now, this is a rule I came up with about, maybe 10 years ago or so. And actually about 10 years into my trading. So I guess about 15 years ago. I began to notice an extreme amount of volatility in the first 30 minutes of every trading day. And after conducting some back tests on trading in the first 30 minutes, my results were astonishingly clear. That is, avoid buying stocks in the first 30 minutes of the trading day. Why? Well, from my own research, I realized that the excessive amounts of volatility in the first 30 minutes of the daily trading session was due primarily to trade executions initiated in the pre-market hours, right? As well as some random market orders being filled right as the market opens. So this onslaught of trade executions upon the market's open serves to temporarily distort prices. So once the early spike in orders slows down, usually by the end of the first 30 minutes, the price action typically becomes much more smooth and predictable, allowing for better trade executions. So while I rarely add a new position in the first 30 minutes of the market's open, I do often sell during that time. So I'll put it to you this way. My favorite time to buy stocks in the trading session is in the final 30 minutes of the trading session. So at the very end of the day, I like to buy. That's when I buy. But my favorite time to sell stocks is actually the opposite, in the first 30 minutes of the trading session. This is where you often have that extreme volatility, as we mentioned. And as we refer to this time as amateur hour. And so you can often get a good price if you're trying to sell in the first 30 minutes. And inversely, you can often get a better price when you're trying to buy in the final 30 minutes. My 2 cents there: avoid buying in the first 30 minutes of the day. Now, there is a strategy we teach our members here at followthemoney.com, very powerful strategy called trading the open. So I do break this rule for one very specific type of day trading strategy. But if you're not a day trader and you're not using that specific strategy, then I would say avoid that first 30 minutes. Let's move on to rule number 8. We're moving right through our top 10 trading rules for success. And this one is an important one. I just got off the phone with an interview with Michael Sincere. If you've never read his book, Understanding Options, it's a fantastic book. I had an opportunity to interview him the other day for our podcast. And when I talked to him, he was talking about options, and I couldn't agree with him more. You know, if you have a small trading account, consider options. Don't be afraid of them. Many people will turn to penny stocks instead of thinking about options first when they have a small account. I want to urge you to consider options. After coaching many new traders over the years, I found that most face the same problem: the small amount of trading capital, right? They get started, they don't have very much capital. Well, you don't have to have much money to trade with cheap penny stocks, for example, because they look attractive and you think, well, I can just trade these and it'll all work out. After all, it seems much more realistic for a cheap, stock trading for $1 to double than it is for a $50 stock to double. But this reasoning is faulty, as witnessed by the number of penny stocks that fail every year. So if you have a small trading balance and you're tempted to focus your efforts on buying penny stocks, let me just try to stop you here. Let me just say don't. Why? Because penny stocks are cheap for a reason, and they are much more likely to fall in price than to rise in price over time. You're much better off, if you want to speculate, to invest in some time learning about options trading. When used properly, options are far less risky than penny stocks and can give you exposure to higher quality companies for a fraction of the price. So put simply, new traders with small trading balances should focus on buying call options on high quality companies and high quality stocks instead of risking everything upon highly volatile, little known, low volume penny stocks. My 2 cents here: don't be afraid of options. Consider them. Many people can get weirded out by options and they seem somewhat counterintuitive, but believe me, it's worth the education. You'll find a lot of great value if you dig into options. Rule number 9 is avoid stocks trading below a declining 200-day moving average line. Now, this one seems pretty simple, but I tell you, this one's powerful. The 200-day moving average line is a powerful metric that many financial institutions and hedge funds add to their trading algorithms. Most smart traders avoid stocks trading below their 200-day moving average. But that caution is even more pronounced if the stock is trading below a declining 200-day moving average. So there's only a couple of situations where I would consider trading a stock that sits below a declining 200-day moving average. Let me tell you what these are. Number one, if I'm seeking to sell a stock short, if I want to short a stock, well, then I'm attracted to a stock trading below a declining 200-day moving average. Also, if the stock chart has formed a clear bottoming pattern and it appears to be rising on rising volume and on strength, I'm not going to be too I might consider buying that stock as it's emerging from that bullish pattern in an oversold situation. It's tempting to trade stocks that are at or near their all-time lows, but bottom feeders rarely get lucky. In fact, trying to successfully buy stocks locked in brutal downtrends is a lot like trying to catch a falling knife. Somebody usually gets hurt. Many traders have seen their trading capital get wiped out by chasing downtrending stocks further down in price, thinking to themselves, it has to go up, it can't go any lower, only to find out that stocks can go much, much lower. I prefer to trade stocks in clear uptrends. Trading above a rising 200-day moving average line is my sweet spot. Even better, when they first break out above a 200-day moving average, that's a really nice sweet spot as well. But again, I avoid stocks that are trading below a declining 200-day moving average line. It's a good rule of thumb when you're getting started in trading. Let's move on to our final rule today. And then if there are any questions, we'll be happy to address those. Trading rule number 10 is paper trade, paper trade, paper trade. So before using your own hard-earned money to speculate on Wall Street, I strongly advise that you first test out your trading plan on paper and do so for a period of months. In other words, act as if you're really trading and record your trades on paper. And when your trading plan tells you to sell, close out the trade on paper and check your results. And no amount of paper trading is going to be able to prepare you for the raw emotions that you're going to experience when you trade real money. But it can help you kind of fine-tune your trading plan for sure. Even better than simply recording your imaginary trades on paper, commit to learning from both your paper trading successes and failures. Once you place real money on the line, the experiences and lessons that you've learned from months of paper trading with your own trading plan will serve to give you confidence in your decisions. There are several free online paper trading systems that basically can accurately simulate the market's action and give you a feel, for trading before you commit your own hard-earned money. Do yourself a favor and paper trade your trading plan, right? Create a trading plan, figure out a strategy, and paper trade it for a minimum of 90 days. I'd say a little bit longer. A lot of the big option firms and a lot of the big hedge funds and investment firms, they won't let brand new guys come on and just start trading. Even these guys who are experienced, they have to paper trade for a period of time. So you as a retail trader, you should do that with your own money. Protect your money. That's rule number 1, by the way, really, is just protect your money, right? That's really what we're saying here through all of these rules. And by paper trading, you're going to be able to test out your system ahead of time and not find out after you've burned through half of your capital that strategy didn't work. Find out that it doesn't work before you put real money on the line. Paper trade your ideas, and you can prepare yourself for what's ahead. Again, I want to stress on paper trading. Some people are against paper trading because they say, well, if you paper trade, then you don't really have the full emotion that you're going to feel when you trade real money. So it's kind of futile. But I would strongly disagree, having coached many, many people over the years. Paper trading a strategy before you use it and deploy it with real money is wise. Very, very wise. So let me conclude today's presentation with just a simple final conclusion here. And that is, don't give up, keep learning, and success is within reach. You can do it. If you're new, if you're here at Money Show and this is your first Money Show, or maybe you've been considering getting investing, or maybe you're a new investor or a new trader, just don't give up. If I had given up many years ago, I wouldn't be where I am today. And many of our students, they wouldn't be where they are today either. So a year from now, 2 years from now, you can either have a good trading plan in place. You can have active trading or position trading or swing trading or options trading, whatever you're wanting to do, you can achieve that. But you have to keep learning and know that you can't give up. Success is within reach. We have a lot of free resources on our website, a free podcast, free videos, all kinds of information. As I mentioned, also our market tracker. I encourage you to go to our website, followthemoney.com, and find all those free resources we have for you right there. It's been a pleasure today. And if there's any questions, I'm happy to address them.
All right, Jerry, thank you so much for that presentation. We had a few of the viewers, they were just wondering if there's any way possible that they could get the slides or at least a list of the 10 rules.
Yes. And in fact, the 10 rules can be, they're on our website. If you go to our website, followthemoney.com, and right there on the front page, if you enter your name and email address, you'll automatically get these 10 rules sent in a beautiful PDF right to your inbox. We have it all set up.
All right. Perfect. Thank you.
So just go to follow the money. Yeah, you bet.
All right. Another viewer here, they're wondering, do you follow the off-market exchanges as well?
The off-market?
They did say off-market. Yes. Maybe we can get them to elaborate it. Okay. Another viewer here, they're wondering, what % do you set your stop losses to?
Okay, so I use a few different strategies. It all really depends. So one strategy is to use a set percentage, which is very powerful. So if you're swing trading, for example, you usually want to do like a 1 to 3 kind of strategy. So you risk 1% for every 3% that you could earn. That's usually how I will approach it. So if I think that I can earn 9% from a stock, over a period of time on a swing trade, then I would set the stop loss probably around 3. You don't want to be risking 9 to earn 1%, for example, or even 9 to earn 9. So you really want to try to make that a 3-to-1 ratio if possible. Some try to do 4-to-1, but that might be a little bit unrealistic. Another strategy that you can use is very, very powerful, and I've been using this one for a long time, is to use the ATR indicator, the average true range indicator. And what you basically do is you apply that to a chart and you look at the value of that indicator. And that's based upon volatility. And what I do is I'll take that ATR, and this is oftentimes how I'll find if I want to trade a stock, is I'll look at the ATR and I'll look at the numerical value of it, and I'll double it. And that with that doubling of that ATR value becomes the dollar amount that I'll actually place the stop loss. So in other words, if the ATR is like 1, then I will place a $2 stop loss. It'll be $2 below the entry price. And if that turns out to be a 3-to-1 ratio, that's great. But if it turns out to be much more than that, then I say, well, this might not be a very good thing, because the ATR will show you how volatile that stock has been over a period of time. So the ATR is a really powerful way to set your stop loss. Percentage-based are also very powerful. Some people use a time-based stop loss. If a stock hasn't moved in 5 days, for example, they just automatically sell it. So there's many different ways, but I tend to use a percentage-based with a 3-to-1 return risk ratio, and the ATR sometimes, which helps me determine if a stock is worth trading.
All right, thank you so much. We had another viewer right in there wondering, do you dollar cost average as the stock is going up?
Yeah. So for example, we dollar cost average, into some stocks like the S&P 500, for example. We've been dollar cost averaging into the NASDAQ 100 for years, into our IRAs. Even Bitcoin, we've been dollar cost averaging in Bitcoin forever. And so, yeah, it doesn't really matter. So dollar cost averaging is just kind of blind to the price. It really doesn't matter what the price is. You just dollar cost average. You just set up it automatically. So like with Bitcoin, for example, we dollar cost average every 2 weeks. Doesn't matter what the price is. However, that said, I use a really cool strategy called the extreme value zone that we teach our members here. And so when a stock or Bitcoin in this case goes down to a certain percentage down from its all-time high or previous all-time high, or previous to high, I should say, then we double up our dollar cost averaging. Usually that's in a 60 to 80% discount range. So sometimes I'll double up my dollar cost averaging, but it doesn't matter which direction it's going per se. We'll still automatically dollar cost average into it. That's clearly different than trading. Dollar cost averaging is for investing. And by the way, investing and trading, 2 wildly different topics. One of the most important things that a new person can do is make sure they understand the difference between those 2 activities. You never want to open a trade and then turn into an investor on that trade, right? Vice versa. You don't want to invest and then start trading your investments. So make sure you know the difference.
All right, thank you. Another viewer, they ask, what is the DMA line again?
200-day moving average. The 200-day moving average line is what we use, and you can apply that on any charting package. Very powerful indicator. Moving averages are probably my favorite indicator out of all of them. They're so powerful. And we use the SMA, so the simple moving average. That's the one that all the big hedge funds, institutional funds use in their trading algorithms. When a stock goes below the 200-day, for example, Paul Tudor Jones, one of the biggest traders of the last 50 years, says he just sells the stock. So he literally just that's his line in the sand, is the 200-day moving average. Powerful line. Always know where that is on your stock. We always keep track of all of our stocks and know exactly where is that 200-day moving average. Where's our stock in relation to it?
All right. Another attendee here, they're wondering, do you sell stocks short below a declining 200-day moving average?
We can. Yeah, we don't short stocks too often. Typically, if I do want to short a stock, I will buy a put. So that's usually my preferred way to do it, as opposed to selling the stock short, because that way I have some limited risk. With selling a stock short, the risk is technically unlimited. So I prefer to buy a put on a stock if I'm going to sell it short, to do it that way. But overall, I just don't do that a whole lot. And in fact, what I'll often do is if I'm really, really itching to make money from a downtrend in a market, I'll usually just use an inverse ETF. So for example, the S&P 500, if I thought the S&P 500 was going to go down, instead of buying puts on it or trying to short it, I would just buy the inverse ETF, like SH, for example, which that particular ETF is designed to go up whenever the S&P 500 goes down. So inverse ETFs allow you to kind of stay in that normal routine of not thinking in terms of shorting or options. You just literally just buy it and it goes up whenever the market goes down. So I usually use inverse ETFs, to be honest.
All right, thank you. We have time for just one or two quick more.
Yeah, happy to address them.
They were asking if you had any rules on trading futures.
Oh, I would say that they probably, most of these all apply. I would say that the majority of these apply. Paper trading obviously would apply. Using the 200-day moving average would apply. Avoiding the first 30 minutes, I think, would apply. Not averaging down. Keeping a trading journal. I mean, I think all of these would apply. One of the things that really probably doesn't is the low volume, because typically in futures you're going to have a much more liquid market. Usually, it all depends what you're trading, but usually you got more liquidity.
All right, and to close us out, a few of the attendees were asking if you recommend any or know of any free paper trading systems that are available.
That's a great question. And the best paper trading systems that I have found, and I usually tell my students about, are the ones that are provided by their brokerage firms. And I want to say, and I may be wrong on this, please forgive me if I am, but I want to say that TD Ameritrade TD Ameritrade, unless they've been bought out, offers one. And I believe Fidelity does as well. So I would check your brokerage firm first before you go out and have to pay some sort of fee. There are some out there that you can pay a fee for, but check your brokerage account, because oftentimes they'll provide those to you for free, or they'll have something similar to it. And even at that, you could also just consider using an Excel spreadsheet. Set up the Excel spreadsheet in such a way where you can kind of keep track of it. And you can port in real data, financial data, into an Excel spreadsheet very easily, and and then run it there. That's free.
All right, everyone. Well, you are watching Money Show's Virtual Expo. We are speaking here with Jerry Robinson of followthemoney.com. Be sure to check out his website. Grab that PDF with all these rules. Jerry, thank you so much for being here. We appreciate your time.
Oh, it's my pleasure. Thanks for the invite. Great to be here. God bless everybody.